Morning, everybody. Welcome to our fossil-free and impact investing seminar. And I'd also like to welcome our webinar participants as well. For those who don't know me, my name is Sue Talbot, and I'm a partner and portfolio manager here at Janus. And we have lots of Janus staff in attendance as well, but I'd just like to introduce the other portfolio managers here. We have Leslie Cliff, who is one of the co-founders of Janus. We have Grant Conroy. We have Stephanie Choi, and we have Thomas Irwin. So let's get started. I'd like to introduce our presenter today, Mike Thiessen. Mike is a partner at Janus, and he's also the Director of Sustainable Investments. Mike?
Great. Thank you all for coming out today. Oh, mic just turned on. Thank you all for coming out today. This is quite an exciting topic, especially right now with everything that's going on. So today we're going to talk about your investments as a tool against the climate crisis. So we're going to look at fossil-free investing and impact investing. And right now it's especially important given everything that's going on. We've had the climate rallies recently, climate strike in the recent election. Climate action was a big deal and something that a lot of the candidates talked about. Even in the States right now, a lot of the candidates are talking about climate action. And I think that using our investments, we really can have effect on the climate crisis. And we can significantly reduce our carbon footprint. So we're going to go over a little bit about Janus, and then we're going to talk about fossil-free investing and sustainable investing. So at Janus, we have clients that are really on the frontier when it comes to sustainability and when it comes to fighting the climate crisis. And they've really encouraged us and pushed us to become better and better at sustainable investing. And because of this, we've been able to be on the forefront of the invest movement. So divesting from things like fossil fuels, investing in securities and investments that are more impactful, like renewable energy. We have been managing sustainable investments for 20 years now. So we really were early adopters when it comes to sustainable investing, fossil-free investing. And this is largely because at Janus we're a client-centric firm, so we're always listening to what our clients want. Plus it's something that we are quite passionate about ourselves. We offer a full suite of fossil-free funds and impact solutions. We have Canada's only 6-year fossil-free balanced track record. And we've created Canada's first public high-impact equity fund. So this has a 5-year track record now. And so we are also early adopters when it came to impact as well. And Janus's research shows that divesting from climate-impacting fossil fuels has not sacrificed returns. And I think this is a very important point, especially when we're wanting to scale up sustainable investing, scale up fossil-free investing. We need to see the financial returns as well. So we'll get into some of that research a bit later. So Janus, at Janus we just celebrated our 30th year anniversary. We offer sustainable solutions to changing client needs. As I said, we're quite a client-centric firm. In terms of assets under management, we have $1.6 billion in assets under management, about 1.1 coming from wealth management clients, and then about $500 million coming from foundations and other institutions. And as I said before, we have clients that are really on the frontier when it comes to sustainability, when it comes to climate action. So here are a few of our public clients. So we have clients that are part of environmental foundations, like the David Suzuki Foundation, like Clayoquot Biosphere Trust. We have clients that are in education, like BCIT, or the arts, like Vancouver Art Gallery, or the Vancouver Symphony Orchestra. We have clients that are public foundations. We also have religious organizations as clients that are quite sustainable and fossil-free. And at Janus, we are committed to sustainability, and it's really, it's part of our core at Janus. We have a strong sustainability policy, and we're signatories to the UN Principles for Responsible Investing. We're members of the Responsible Investment Association. We've signed the Montreal Carbon Pledge, the Carbon Disclosure Project. but something that really sets us apart as an asset manager is that we're a certified B Corp. It's quite rare for asset managers to be B Corps, and I believe we are one of the first in Canada to become a B Corp. And what it means to be a certified B Corp is that we're a for-profit entity, but we're striving to be a force for good in society. And in order to become certified, you have to pass rigorous testings, and you have to be accountable to certain sustainable and impact metrics. So in order to become a B Corp, we had to show that we had products that were sustainable and impactful. And so we had our fossil-free funds, our impact fund. We had to show that we were a diverse firm. And at Janus, we have diversity all the way from the leadership down to entry-level positions. We're an employee-owned firm, and we have quite a strong sustainability policy. So all of these factors really helped us in becoming a certified B Corp as an asset manager. So now we'll get into sustainable investing. We'll talk about how we can invest sustainably and what the overall effects are of sustainable investing. So first, we'll start with the why. So why would we decide to invest in a fossil-free manner? Why would we decide to invest sustainably? And here is, a big reason for that. There is a relentless rise of carbon dioxide in the atmosphere. You can see that over hundreds of thousands of years, the carbon dioxide in the atmosphere hasn't gone above 300 parts per million, but in 1950, it bypassed that threshold, and ever since then, it's been growing. It's been increasing very quickly. And right now, we're at about 430 or 435 parts per million in the atmosphere. So a lot of people see this, and they see this connection to climate change. And they also, they don't want to be part of this climate change. They want to be mitigating the climate change and reducing their carbon footprint. So that's a big reason why a lot of people decide to divest and why people decide to invest sustainably. So this would be the values perspective of why to divest. Investors that are investing in fossil fuel companies or other companies are essentially funding these companies. So as a stockholder in a fossil fuel company, you are really an owner of the company. So if you're wanting to mitigate climate change, if you're wanting to be a strong proponent in climate action, you shouldn't be owning a fossil fuel company, or you shouldn't be owning other controversial industries that you don't agree with. And then other people decide to divest due to a financial perspective. So when you're holding controversial products that tend to harm people or harm the environment, then you're going to be open to more risks. You're going to be open to risks such as litigation, and we've seen this in the tobacco industry, and we're seeing this a lot in oil and gas and the fossil fuel industry right now. You're going to be open to more risks with taxation. We're seeing this with the carbon tax, also regulation, and then there's going to be more cultural backlash as well. And we're certainly seeing this with fossil fuels right now and all the climate rallies. So divestment is really a social phenomenon. And we see this phenomenon happening in 3 different waves. And we've seen this with the tobacco divestment. We saw this with the weapons divestment around the apartheid in South Africa. So within these 3 waves, the first wave is typically religious groups and activist organizations or foundations deciding to get out of a certain industry. So fossil fuels being the case now. And we've certainly seen this in Canada. We have a lot of activist type clients. We have a lot of religious organizations, churches that have decided to divest because it's really against the core of why they exist, of their mission. So they don't want to be a part of fossil fuels because they want to be good stewards of the environment, or they want to be strong proponents against climate change. And then the second wave is typically universities, cities, public institutions. And globally, we've seen universities decide to divest. Especially in Europe, a lot of universities are divesting. We've seen cities around the world decide to divest. New York City, San Francisco, Paris, London has decided to divest. Certain countries have divested. So Costa Rica has decided to divest. So globally, I would say that we're probably in the second wave. But I think here in Canada, we're just starting to enter the second wave. We have universities considering divestment. Often universities are deciding to lower their overall carbon emissions in their portfolio, or maybe they're taking a portion of their portfolio and they're deciding to invest more sustainably with that portion of the portfolio. But it's quite rare in Canada for a university to fully divest. So I think we're just starting that second wave in Canada. And then in terms of the third wave, in Europe and in certain other areas of the world, they might be starting the third wave. There's some pension funds, which would be included in the wider market, that are starting to divest or at least consider divesting. And a lot of retail clients are considering divestment, especially in certain areas of Europe. But in Canada, we're definitely not at the third wave yet. But I think it's going to come. So when we talk about sustainable investing and fossil-free investing, there are many different terms. And so I think that it's good to look at a spectrum of different sustainable investment styles so that we can all be on the same page when it comes to certain terms and know kind of the different options that we have when it comes to sustainable investing. So first of all, we have regular investing. So this is what everyone knows. You're trying to maximize your overall return, minimize your risk. Next, we have responsible investing. So with responsible investing, you're starting to consider environmental factors, social factors, but you don't necessarily have to take action on them. So maybe if you're investing in an insurance company, you might want to look at different environmental factors, but you're only looking at these factors really if it's going to benefit you or if you think it's going to benefit you. So that would be responsible investing. Next would be socially responsible investing. And with socially responsible investing, you are starting to draw a line and saying, okay, I will invest in this, I won't invest in this. So maybe it's tobacco you don't want to invest in. You're saying I'll invest in everything else, just not tobacco. Or within our fossil-free funds, we're not investing in fossil fuels. So you are drawing a line, what you're going to invest in, what you're not going to invest in, but you're still able to have public market return, public market risk. And then the next category of sustainable styles is mission-based investing or impact investing. So this is where you're not just taking out the bad stuff from your portfolio, but you're actually putting in the good stuff. So instead of just taking out tobacco, maybe you are investing in things like an innovative new healthcare company, or instead of just taking out fossil fuels, maybe you're investing in renewable energy. So you're starting to look at positive screens, they call them. So you're trying to make that environmental or social impact. So the first category here is liquid impact. So this is impact investing where you're investing in stocks or liquid bonds or funds that are holding stocks or bonds. And you're still getting public market return, public market risk. You're considering ESG. And Janus has a fossil-free high-impact equity fund that would fit in this liquid impact category. The next category is illiquid impact. So here you're making impact, but your money will be locked up for a few years. It might be 2 years, 5 years. It could be 10 years for some private equity funds. So within illiquid impact, you could be investing in things like private debt or private equity or real estate, infrastructure. And then we have venture impact. So venture impact is venture capital, but with an impact focus. And then finally, we have philanthropic impact. So philanthropic impact is a unique type of impact investing where you are deciding to give up some return or take on additional risk to have that impact that you're wanting to make. And it's a common misconception that all impact investing is like philanthropic impact, where you're having to give up something in order to get the impact. But a lot of studies show that you are able to have similar returns with impact investing as you are just with regular investing or responsible investing. So Janus has listened to clients and heard what they don't want to be investing in. So these are kind of our negative screens, they call them. So this would be kind of within the socially responsible category. And so these are some products that we don't invest in within our fossil-free funds. So here we'd have products like fossil fuels, weapons, gambling, junk food, nuclear, adult entertainment, alcohol and tobacco, GMO. And then also within our fossil-free funds, our sustainable funds, we rank the stocks based on environmental, social, and governance factors. And then we take out the bottom performers in those areas. We also look at the underlying pillars of environmental, social, and governance. So things like climate change, biodiversity loss. We look at things like human rights or business ethics. And we make sure that we don't have the worst of the worst of in those areas within the portfolios as well. So to look a bit deeper into what we mean when we say fossil-free, because there are some different definitions of what fossil-free is, what fossil-free investing is. So for us at Janus, we again have listened to what our clients want when it comes to fossil-free investing. And our clients have said that they don't want to be investing in oil and gas refining, storage, marketing. They don't want to invest in oil and gas producers. They don't want to invest in energy equipment and energy services companies, companies that are transporting fossil fuels. So this would be things like pipelines. This would even include railways that make most of their revenue from oil and gas. And also companies in the utility sector, unless they're purely renewable energy. And when we build a portfolio, we need to continually monitor the portfolio and look at different controversies that come up. So here you can see a cartoon about the emission scandal around VW that happened in 2014, 2013, 2014. So we continually are looking into controversies like this and avoiding controversies that are either widespread or quite severe. So the VW scandal would be something that we would look at, and because of this, we've decided not to invest in VW. And there's other controversies, such as some recent ones like SNC Lavalin that we've used to, we decided not to invest in that. Other ones in the States like Wells Fargo and their aggressive sales tactics. So it's important to continually monitor the portfolio for these controversies. So there's a lot of different colors here, but this is the results of all of the sustainable investing, all of the fossil-free investing. This is what our clients get in the end, and also financial returns as well. But we'll get into that shortly. So first, on the left here, we have fossil fuel reserves. So you can see the first three funds have 0 reserves, and these are fossil-free funds. These are the Janus fossil-free funds. And then beside them in the red and the blue line are the benchmarks. So these are the indexes that we compare our funds to when it comes to financial returns and when it comes to the sustainable metrics. And so they have significant fossil fuel reserves. So the one benchmark, which is 35% TSX, 65% MSCI World, it would have 410 million barrels of oil equivalent within the portfolio, whereas if you compare it to our fossil-free portfolios, they would have 0 fossil fuel reserves. And so in order to have 0 fossil fuel reserves, you can't just cut out oil and gas. You also have to look at other companies that might hold fossil fuel reserves as well. A lot of mining companies will have fossil fuel reserves, even though we will invest in other mining companies, but not if they have reserves. And then we also look at carbon intensity, and we can drastically lower our carbon intensity by investing fossil-free. So carbon intensity is the tons of carbon emissions that a company is emitting per million in sales. So a company like a coal utility is going to have massive carbon intensity. So they're going to be emitting many tons of CO2 for every million in sales. Usually for a coal utility, it might be about 10,000 tons per every million in sales. But then other companies like tech companies or financial companies, they're going to have much lower carbon intensity because they don't emit very much carbon per every million in sales. So their carbon intensity might be something like 10 or 15. So it greatly varies. So you have coal utilities at about 10,000, 15,000. You have tech companies at about 10 or 15. So depending on which industry you're investing in, depending on which companies you're investing in, you can drastically decrease the carbon intensity in your portfolio. And that's decreasing the carbon intensity of your overall investments and lowering your overall footprint. And then we also have ESG ratings. So ESG standing for environmental, social, and governance. And through sustainable investing, we can have higher ESG ratings on average within funds than our benchmarks as well. Another critical element of sustainable investment is engagement. So if there's an industry that doesn't align with our values, then we decide to divest from that industry. But still, when we're investing in the other companies within the portfolio, there's going to be some areas that we want to encourage them to improve on. So these are the engagement themes that we work with companies on. So first we have climate transition, we have decent work, human rights, reconciliation, water and plastics, which is new for 2019, and then corporate governance. So we work with a great organization called Share, and they help us work with a lot of these companies and try and make them better and better, which makes our portfolio better. So one question that we often get from clients and from potential clients is, I want to invest sustainably, I want to invest in a fossil-free manner, but what does this mean for performance? I still need to make money for retirement, I still need to make money for kids' tuition, whatever it might be, so can I still perform and be fossil-free and lower my carbon footprint? And so we've done a lot of studies, a lot of scenario analysis, back tests for clients, looking at this issue. And our conclusion is that you don't need to be investing in fossil fuels in order to get good performance. You can have a fossil-free portfolio and still have great performance. So here is a back test that goes back about 21 years. So we looked at the market in Canada, the US, international, globally. And then we looked at those same markets and looked at the performance if you were to take out fossil fuels. And if you were to go fossil-free and do it in an optimized way, we'll get more into what optimized means in a later slide. If you were to be fossil-free optimized, you would be able to significantly beat the market on an annualized basis in Canada, in the US, internationally, and globally. And that's over the past 21 years. So with this, we can certainly tell clients that you don't need fossil fuels for performance. And just to drive home the point even more, so this is our live performance of our fossil-free flagship fund. So this flagship fund is called our Janus Fossil-Free CanGlobe Fund. And it's been operating for 6 years, so it has a 6-year track record. And over this 6-year time period, the annualized return has been 12.7%, versus the benchmark that has a return of 11.5%. And the benchmark does include fossil fuels in it, whereas our fossil-free fund, of course, doesn't have fossil fuels. So with our back test and with live performance, we've been able to show that you don't need fossil fuels for performance. And again, just more performance of fossil-free investing. So this is our fossil-free institutional balanced composite, which means it's a combination of all of our balanced mandates for institutions. And overall, the performance for these balanced mandates have been 7.88% versus the benchmark, which is 7.45%. And again, that benchmark has fossil fuels in it, whereas our fossil-free institutional balanced composite doesn't have fossil fuels. So now we'll get into a little bit of how we make fossil-free work. And one way that we do that is we think globally. So if you look at Canada, if you look at the TSX, about 30% of the value of the TSX comes from oil and gas, refineries, utilities, transporters of fossil fuels. So that's a massive portion of the overall index. And it makes it quite difficult to fill that gap because you have to fill that 30% with the rest of the 70%. And it can skew the portfolio quite a bit. So we think globally, because if you look at a global index, fossil fuels make up only about 10% of the overall index. So it's much easier to fill that 10% gap rather than the 30% gap. And then when you think globally, you can choose the best of the best stocks from around the globe, and you're able to optimize your portfolio better for risk management. So Another way that we do it is we energize portfolios without energy. So this is the optimization that we had talked about before with that back test. So when we take out energy out of the portfolio, we don't just increase all the other weights of every other company in the portfolio. We actually look at what sectors, what industries, what companies are highly correlated with oil and gas in the short run, and we fill that gap with those companies. And in that way, we're able to have similar performance to the market in the short run, but we believe we'll have better performance in the long run. So this is what we call optimization, and we have software that's able to do this for us, that is able to find these highly correlated industries or companies to fill that gap. So now we'll move on to impact investing. So impact investing is an area of sustainable investing that has been fast growing. It's been highly talked about topic with a lot of foundations that are really wanting to maximize their impact as an organization. A lot of individuals and families have been started to get into impact investing, and it's something that Janus has been doing for the past 5 years. So with impact investing, you're trying to achieve both your financial goals and make a social impact or an environmental impact. This enables you to activate more of your financial resources to do good. So you're not just doing good with the amount of capital that you're using to possibly donate to charity, or if you're a foundation, then it might be you have 3.5% that you need to contribute towards certain programs. But with impact investing, you can activate your entire portfolio or whatever portion of your portfolio you devote towards impact. And you're able to have bigger total returns when you account for social and environmental benefits that you're making on top of the financial benefits. So sometimes we like to use this iceberg analogy when looking at a portfolio and looking at the impact. Above the water, you have kind of all your traditional portfolio returns. You have growth, you have income, you have your financial returns. But then below the surface, you also can have a large benefit, and you have the potential to do a lot of good through impact investing. So you have a different type of return that's below the surface that you're able to activate. So just some impact investing examples. So within our Janus Fossil Free High Impact Fund, we have these companies that are within the fund. So we invest in things like renewable energy. So we have a company in there called First Solar. So they're based in the U.S. They design, engineer, manufacture, construct large-scale solar power plants for global companies. And we also invest in energy efficiency companies like Citrix. So Citrix is a cloud computing company, and cloud computing is much more energy efficient than local computing. So as a result, they're able to lower the carbon footprint of their clients. We also invest in companies that operate green buildings. So like Capital Land out of Singapore. So Capital Land makes about 83% of its revenue through operating, leasing, and constructing green buildings around the world. We also invest in companies that have social impact. So social impact in healthcare. So we invest in companies like Jazz Pharmaceuticals that have made large advancements with cancer treatments. We invest in educational companies like Benisi Holdings out of Japan. So they have products, educational products and apps and educational services for students. We also invest now in private impact investments as well. So here's an example of a private debt instrument that we have invested for certain clients. So this is CoPower. So CoPower is a private debt product, and the proceeds go towards clean energy infrastructure. And they also devote some of the proceeds towards energy efficiency projects. And through a private debt instrument like this, investors are able to get a 5% return over a 6-year time period, and they're able to make impact when it comes to sustainable cities, climate action, responsible consumption, and they measure the impact that they're making by measuring CO2 emission reductions. Another example of a private impact investment is a venture capital firm like Rise's CVR3. So this is an organization that invests in businesses in BC that are either making a social or an environmental impact. So they have a higher projected return because there are venture capital, but of course there is investing in venture capital, and they have an 8-year term. And since they're investing in companies in BC and companies that have high percentage of their revenue going towards research and development, the investors in this fund are actually able to get a tax credit as well. And in terms of impact, they want to make impact when it comes to good health and well-being, climate action, decent work, and economic growth. So a lot of our foundations that we have as clients, they measure their impact, they measure their programs by how they're contributing towards sustainable development goals. So these are the UN Sustainable Development Goals, or SDGs, that were adopted in 2015. So it's 17 different goals that cover different areas of impact around the world. So everything from lowering poverty, you have healthcare, education, you have clean and affordable energy, climate action, and underlying each of these 17 goals are kind of sub-goals underneath these as well. So a lot of our foundation clients are focusing on these. So we decided that for our impact fund, we are going to focus on these as well. So when we're measuring how much impact our high impact fund is making, we look at the percentage of revenue that the companies are generating from impactful products or services. So a company in our portfolio like Vestas Wind Systems, that's out of Denmark, they manufacture about 17% of the wind turbines around the world. 100% of their revenue comes from impactful products. So they would have 100% impact. And then we might invest in other companies that have energy efficiency projects, but maybe that's about 40% of their overall revenue. So then that would be 40% impact. And within our impact fund, we want to have an average impact within the companies we're investing in of about 50%. And right now within that fund, I think we're at about 57% of revenues are generated through impactful activities. Also within our impact fund, we focus on 9 different themes. So we have 4 themes within environment, so very similar to the Sustainable Development Goals, 3 in social, and then 2 that are both environmental and social. And then when we're measuring our overall impact of the Janus Fossil Free High Impact Fund, we compare it to our benchmark. So it's the benchmark that we also compare our financial returns to. We compare our impact to. And as you can see, it's the middle pie graph there. It's MSCI World. About 6% of the revenues generated by companies in that index comes from impactful services or products versus over 50% for our impact fund. Now again, a big question that comes up, not just with fossil-free investing, but also with impact investing is, this sounds great, but I also need to make performance. I need to save for X in the future. So there have been multiple studies on impact investing and the performance. There isn't as much data around impact investing just because it is a more emerging area of investing. But if we look at the Wharton study in the middle there, they looked at 53 different impact funds over a 14-year time period. Within those funds, there were 170 different impact investments, and their average annual return was about 13%. And this was right on their benchmark, which was the Russell 2000. So they were quite happy with these results. Also the IFC, so the International Finance Corporation, they did a study over a 10-year period where they invested $2 billion of their dollars in a bunch of private equity funds, mainly in the emerging markets. And they found that their annual return was about 20% over that time period, which greatly surpassed the benchmark that they had set out to have. And then Jin on the left did a study based on expectations. So they talked to a bunch of impact investors, impact owners, asked them what they expect their return will be. And the average investor said that they expected their annual return to be about 9.5%, if they were to invest in developing markets, and about 15% if they were to invest in emerging markets. And then they also asked them later, how many of you met your financial expectations, and about 91% said that they met their financial expectations. So at Janus, we've done sustainable investing and socially responsible investing for about 20 years now. We've had 6 years of fossil-free funds. We've had 5 years of impact investing within public markets. And then now for the past year, we've started to invest in private markets for impact. So we have teamed up with an organization called SVX out of Toronto. So SVX is a platform where people can go and they can buy private impact investments. And SVX is really at the cutting edge when it comes to private impact investing in Canada. So we're working with them to create customized impact portfolios for clients that are across all asset classes. So clients can be invested in public equity, they can be invested in private equity, private debt, infrastructure, real estate, a whole variety, and we're focusing on making the impact that our clients really want to make. And at the same time, meeting their financial goals and other requirements that they have. So this is an exciting new area for Janus. So finally, just to summarize, through our investments, we can really make a difference when it comes to climate action. We can lower our overall our carbon footprint. We can lower the carbon intensity of our portfolio, which makes a massive difference. And we don't need harmful investments. We don't need fossil fuels in order to make a good return. We have seen the back tests. We have seen studies showing this, that you don't need to have fossil fuels to make good performance. And Janus is a leading provider when it comes to fossil-free investing and impact strategies. And we're happy to help anybody along their fossil-free journey or impact journey as you move forward. So thank you for listening to the presentation. And if you have any questions, that'd be great.
Thanks, Mike. That was great. That was very comprehensive. Grant?
Well, could you just elaborate on the term greenwashing?
Sure. Yeah. So it's become quite common among a lot of. I'll repeat the question. So explain what greenwashing is. So it's something that's become quite common across a lot of asset managers, even here in Canada, where asset managers are trying to jump on the bandwagon of the whole green movement and make their products look like they're green products. So they might have just a simple screen, or they might make a simple tweak to their portfolio in order to make it look like it's a sustainable investment strategy, just for basically marketing purposes. And that's something that we've been fighting against for a while at Janus, because sustainability is really at the core of Janus, and something that we care a lot about, that our clients care a lot about. So it's a battle for us, trying to educate about greenwashing. Yeah.
It seems to me that you're really trying to do something which is very tangled. You've got things like railways. Now, of course, the Swiss rail is almost monolithic. Canadian certainly isn't. You've got things like banks. They loan to the... Mm-hmm. How do you square these?
Mm-hmm. Yeah, it's quite difficult. You're right, it is tangled, it is messy. There's no clearly defined way to do it. So we're really just trying to do our best and listening to our clients and trying to figure out what they want. So when it comes to railways, we don't exclude all railways. So we exclude railways if a majority of their revenues are coming from shipping oil and gas. So that would be the case for Canadian railways.
They use oil and gas, even if they have diesel
If they're using diesel to operate, then we won't exclude them. But if their primary business is shipping oil and gas, then we will exclude them. So if they're an electric railway in Switzerland, then no. Well, yeah, happy to invest in that. Yeah.
Pressing that a little further, with things like banks, do you weight them? Do you downweight them if they have more oil and gas financial loans and stuff?
Yeah, that's a good question, and that's kind of the second level when it comes to sustainable investing. You're not just excluding the oil and gas, but you're excluding, services to oil and gas, including financing. And that's something that we've looked into a lot, and we actually have additional, more strict requirements for financial companies than we do for other companies because of that. So we have, so if a company is, or if a financial is involved in financing highly carbon intensive industries or projects, like a new coal power plant, something like that, then it will be downgraded. Then it will be seen as a more controversial company.
That would depend presumably on the fraction that goes into that?
It depends on the fraction plus just the severity. So even if they have one very severe case, then they could be booted out because of that. Yeah.
That's probably all you can do.
Yeah.
Is there an example of a Canadian financial company you booted out?
Sorry, Mike. Mike, can you repeat the question, please, for our webinar
Sure.
participants? Thanks.
Sure. Is there an example of a Canadian financial company that we booted out based on severe carbon controversies? Within Canada, there is nothing I can think of, but there has been companies like Barclays Bank that have been funding Arctic drilling and have been funding sourcing of palm oil that is done in a non-sustainable way, and because of that, we've took them out of the portfolio. Also, HSBC because of some controversial funding as well. Yeah.
Hi, thanks. It's been a really great presentation. My question to you here at Janus, you've been at this business for 25, 30 years. And I imagine when you started out that the number of stocks and the companies you could actually select from was fewer than there are today. So I'm just wondering what you've seen in terms of kind of the overall change in the economic mix out there in Canada, or from what you can select from.
Mm-hmm. Yeah, I think there has been a large change. So if you look, I think 6 or 7 years ago, if you were to look at the most valuable companies in the world, it would have been Exxon, Shell, it would have been Chevron, it would have been all these oil and gas companies. And now when you look at the most valuable companies, it's financials, it's tech companies. So there really has been a big change in terms of overall value of these companies and their proportion of the overall index. And companies are making strides in the right direction when it comes to sustainability. So we have seen that there has been more companies available for investment, especially with impact investing. I think probably when the impact fund started, there was very few companies to really choose from, and they probably weren't as impactful as the companies are right now that we have to choose from. Yeah.
So, Mike, can we take a question from one of the webinar participants?
Yes.
Okay, so is cannabis excluded by Janus ESG screening along with alcohol and tobacco?
Good question. So this is something that we haven't asked many times before. And it's probably as popular of a question as, can I get good returns with fossil fuels? So we don't have any cannabis in our fossil-free funds. And we haven't written it in stone that we're not doing that. But for now we've decided not to do that. Because we see cannabis kind of as a mixture of tobacco, of alcohol, and pharmaceuticals. So if there was a pure cannabis pharmaceutical play, then we would be open to that. If it's purely just being used to help people. But in the recreational sense, if we are excluding tobacco, if we're excluding alcohol, then it doesn't make sense to have cannabis in there as well. And in terms of finances, their rankings haven't been great as well. So that's helped the case.
Okay, so here's one more. Would Janus invest in CP or CN?
No. Well, not for our fossil-free funds. So just because a large percentage of their revenue comes from shipping oil and gas, we class them as an energy transporter, just like a pipeline. So we don't invest in them within our fossil-free funds.
Any other questions?
Yes.
Just a sec, Peter, sorry.
So I'm curious about the sustainable development goals and how you report out to clients such as us about the performance of your fossil fuel free or your impact funds against those metrics.
Mm-hmm. Yeah, we can go back to. So we can report on them with something like this. So we look at the overall percentage of revenue generated by these companies that is coming from impactful products or services that are linked to a sustainable development goal. So we can report on this with data, with graphs like this, showing what percentage of the overall revenue is coming from impactful services or products, and then comparing that to its benchmark, like MSCI World, that is significantly lower when it comes to overall impact revenue.
Anybody else?
We could do that, but do we do that? Like, should we start reporting to clients quarterly on these metrics? That's really what you're asking.
Yeah, and I realize that I sort of forgotten, showed that slide. I would also be curious about if it's fossil fuel free. I'd be curious about the reduction in GHGs that we've seen versus the benchmark.
Mm-hmm. Yeah, that would be interesting as well. Right now we focus mainly on carbon intensity. Sorry, I keep forgetting to repeat the question. So there's an interest in reporting on GHG emissions for the fossil-free funds. So I think that is something that is interesting that we definitely could and probably should look into. Right now we look at carbon intensity, we look at fossil fuel reserves, but it'd be interesting to look at GHG emissions, and then you could even link that to your own personal footprint as well. That would be easier for you to use.
Any other questions?
What's your position on nuclear power?
Okay, our position on nuclear power was a question. So for nuclear power, we have decided to omit that from our fossil-free funds. But nuclear power is quite a controversial area. So there's some people that are wanting to fight climate change that think that nuclear is a big part of the answer, such as Bill Gates. I don't know if you've seen the recent documentary on Netflix. Yeah. But then there's others that don't want to be investing in nuclear. So what we've decided is to omit it from our funds, and then if people want to hold nuclear outside of our funds, then great. But in order to satisfy most of our clients that are within our fossil-free funds, we've decided to omit it.
I think it's a giant mistake not to include nuclear. And the trouble is the American defense industry hijacked the nuclear industry into uranium. And the actual element they should be using is thorium. And the Chinese are beginning to do this. And I would encourage you to consider adding thorium, but not uranium, if you want an option, because it can't be used in military applications.
Okay. Thanks. Yeah, we'll look into that.
Well, it's early days. I mean, they only just started to build it.
Yeah, right now most nuclear power plants were built, in the 60s or 70s or earlier than that.
Well, that is all
so
the
it's
US and the defense industry. There's nothing to do with the scientific plants, unfortunately.
So Mike,
Cost, because thorium is cheaper and more plentiful.
got another question here for you, Mike.
okay.
Do you consider factory farming in any of your investment portfolios?
Good question. So we actually haven't. Oh, sorry. So for factory farming, this is something that we haven't released yet, but we've done the work into it, studied it, and we're actually going to be releasing it soon. But we're going to make all of our fossil-free funds factory farming free as well. Triple F. So right now we exclude companies that are involved in junk food. So that already cuts a lot of factory farming out. But we're going to do that in addition to the junk food screen. And that probably will be in place probably mid-November, and we'll have a press release soon. So we're excited about that.
Okay. Okay, sorry, we have one more here, Mike, from the
Okay.
webinar. How do you rate the impact of a company that produces solar panel, but in order to do that has to do mining, which is considered very impactful on the environment?
So there are trade-offs with a lot of these companies. Certainly, with electric cars, there's mining that's needed to, especially for batteries, and there's been controversies around that. Certainly, a lot of mining industries are more carbon intensive, but mining isn't even close to the carbon intensity as something like the tar sands or like coal, especially coal utilities. It doesn't even come close. So we do look at that aspect when it comes to renewable energy, but we're still looking at the overall impact that they're making, especially in the long run. If these solar power plants are going to be operational for decades, then the positives definitely outweigh the negatives. And there's been numerous studies on that, and if anyone's interested, I can share some studies.
Any other questions? Well, thank you, everybody. Mike will be hanging around for a little bit, hopefully, and we even have Wayne here, Wayne Michelle, the other co-founder and chief investment officer. So we'll be around if anybody has any additional questions for us, and thank you very much for attending.